Hi everyone, thanks for joining in on this revision webinar looking at some aspects of fiscal policy in the UK. Over the next 15 or 20 minutes or so, I want to really focus on maybe 3 or 4 areas which are particularly relevant to your macroeconomics, your AS Year 1 macro. So let's make a start and let's see where we can get to. Fiscal policy has many roles in the economy. It's quite important to understand that fiscal policy, the use of changes in government spending and tax, and how much the government borrows, has quite a wide-ranging impact both on the demand and the supply side of the economy. We need fiscal policy to finance government spending, so we need taxation to fund the provision of public and merit goods. You can also use fiscal policy if you want to change the final distribution of income and wealth within a country. And of course, many countries use fiscal policy as a welfare safety net, particularly when there's economic shocks affecting employment. Fiscal policy can be an important aspect of managing or smoothing the economic cycle as changes in aggregate demand and supply occur. And many governments are now beginning to realise the importance of fiscal policy from a competitiveness viewpoint, how we can impact on long and aggregate supply and productivity and innovation and so on. And as you revise for market failure on paper 1, you'll know that fiscal policy can be used, for example, carbon tax or taxation of pollution or subsidies for renewables can be used to tackle important market failures. So fiscal policy is wide-ranging. Let's take a look, first of all, at government spending, the big G. Government spending is spending by the public sector on things like education and healthcare and defence. Some of that can be provided by the private sector, much is provided by the state. Total government spending in 2015 was about £745 billion, just over 43% of our national output. And about £50 billion, or £1 billion a week, was spending on investment. Now, with government spending, it's important to make a distinction between 3 main elements. One is welfare, things like social security payments, maybe the job seekers allowance or the state pension. That's welfare, otherwise known as transfer payments. Then we have public services, spending literally on delivering the public sector services that people require. And then we have investment, state sector investment in new bridges, new motorways, infrastructure of various types. It's quite important to make a distinction between current spending and capital spending. So current spending is the G bit in C plus I plus G plus X minus M. So it's spending on salaries of teachers in state schools and nurses in the NHS. It's the funding of drugs used in healthcare, for example, antibiotics. It's filling potholes in the roads, maintaining our public services. It's the logistics associated with the army. So that is day in, day out, week in, week out public services. Capital spending is actually included in the I bit of C plus I plus G plus X minus M. And capital spending is spending on capital goods by the public sector, including public contributions towards new motorways, flood defence schemes, defence equipment, new equipment and new hospitals used in the National Health Service. Capital spending. As we'll see in a few minutes, that is a big part of the current debate about how much the government should be spending and what it should be spending taxpayers' money on. These are the biggest single sources of government spending in the UK. Health, 141 million in the last financial year. Welfare, over 230 billion. And education, just under £100 billion. Notice also that the government spent nearly over £600 million a week on debt interest. But those are the biggest single items of government spending. If we look at this chart, if you follow the orange line here, this is government spending as a share of GDP. And it's risen and fallen over the years. Partly it's cyclical. So, for example, during the recession from 2008 onwards, that had to be almost like an automatic rise in government spending because unemployment was going up and welfare spending increased. And the government also increased some spending in other areas. But, of course, tax revenues in blue, they're more or less a fairly stable percentage of GDP. They rise and fall with the cycle. They fell in 2009, for example, in 2010. But basically, taxation takes about between 36 and 38% of GDP. Once you get to a situation here in 2010 where government spending is 46% of GDP and tax revenues are 35.8%, the difference, of course, is the budget deficit. So this vertical distance is the deficit. And what the government's been trying to do over the years is bring down government spending as a share of GDP. And there's been some tax rises as well to try and reduce the size of the fiscal deficit. Most of the fiscal austerity in the UK thus far has been cuts in government spending as a share of GDP. The government is hoping, once we get to the end of the current decade, that the budget will be in balance again. But as you can see from this chart, it's very rarely that Britain runs a budget surplus. Now, what about tax? Taxation, of course, is the income from compulsory taxes on income and wealth and spending. Biggest single source of tax is income tax, then followed by VAT, and then followed by national insurance. But there's some other big taxes in there. Council tax brings in nearly 30 billion a year. Corporation tax over 40 billion. Should that be more? Should companies be paying more in tax? Tax avoidance, of course, is a big issue at the moment. If you take tax revenues as a share of GDP, you can see that if you add income tax and national insurance together, 2016's forecast is that tax revenues, here's our forecast for next year, that income tax and national insurance will contribute nearly 16% of GDP to the government, and VAT is worth about 6% of GDP. And then obviously as you go down the table, the tax take falls. The crucial bit is the bottom, really, that total tax revenue from the government is rising in the next last couple of years and next year to just under 37% of GDP. So that's steadily rising. It's one reason, of course, why the deficit is coming down. And you're revising fiscal policy, quite important to make a distinction between direct and indirect taxes. Direct taxes are taxes on income and wealth and profit. The burden of the tax can't be passed on. And best examples are things like income tax and inheritance tax and corporation tax. Those are direct taxes. Indirect taxes are taxes on things like fuel, cigarettes, alcohol. VAT, of course, is a big indirect tax. And the producer may or may not be able to pass on the burden of the tax. It depends on the price elasticity of demand and supply. That's mainly micro, isn't it, of course? And we've moved on from micro. That was Monday. Basis on income tax. So the key point about income tax is that everybody has an income tax-free allowance. It's going to rise to above £11,000 next year, but in this example, £10,600. Your taxable income is your gross income before tax minus your tax allowance. So if I had a gross income of £50,000 in a year, I'd take off my tax allowance, £10,600. That means that £39,400 of that money will be taxed. And of that, the first £31,785 is taxed at 20%, a marginal rate of 20%. The next chunk, which will be about £7,000 or so, will be taxed at 40%. And while not really affecting me, but above £150,000 of taxable income, you're taxed at a marginal rate of 45%. So the high rate tax is payable on if you have an income of more than £42,000 a year. So that's income tax. Income tax, of course, is progressive because the marginal tax rate goes up with income. A big evaluation point is the extent to which the top rate should be higher, perhaps, more progressive, or should there be a lower marginal rate at lower incomes. VAT is an indirect tax. It's been 20% since 2011 for most items, but there's a 5% VAT on fuel and power, your utility bills, women's sanitary products, car seats for children, contraceptives. So it's quite controversial as to why some VAT on those products. Some items are zero rated for VAT, so food you get at the supermarket is not subject to VAT. Neither are books and magazines and cycle helmets. And some things are exempt from VAT. Then there's no VAT applied at all. So rent on property, school fees is VAT free, health services, postal services, and burial and cremation. So VAT is a big tax. It's an important tax. And it's important to know that the consequences of VAT for people's real incomes and also for income inequality. When we look at the tax system as a whole, we can come to a view about whether a tax system is progressive, proportional or regressive. Overall, the UK tax system is progressive, but there are bits of it that are less so. So income tax we know is progressive. The marginal tax rate goes up from 20 to 40 to 45. National insurance is broadly speaking proportional, 11 or 12% proportional tax. Regressive taxes, the burden of those taxes falls more heavily on lower income consumers, and typically indirect taxes tend to be regressive, including tobacco and alcohol. Let's have a look at this. If you take the percentage, take households from left to right, we're taking across the top here, so that the first quintile is the poorest 20% of households, followed by the second, third and fourth quintile. We get to the right hand side here, the highest 20% of households, the richest 20%. What this table shows is the percentage of those people's gross income which is paid in various taxes. And you can see that income tax is progressive, because as your income goes up, the poorest 20% of households only pay 2.5% of gross income in income tax, whereas the highest incomes pay 16.7%, 9% of their income in tax. That's progressive. VAT is regressive, because the poorest 20% are paying 11% in VAT, the highest 20% only 5.5%. And duties on alcohol, in particular tobacco, take this one example here. So the poorest 20% of households are paying nearly 3% of their gross income in tobacco duty, whereas for the highest 20% of income users, it's only 0.3%. Overall, taking indirect taxes as a whole, they are regressive. The poorest 20% of households in the UK pay nearly 30% of their gross income in indirect taxes, compared to just 11% of the richest 20%. Although, of course, the richest 20% will be paying more in income tax and also in national insurance, for example. So overall, the tax system is probably progressive, but not as progressive as it might be. I think the key thing when you're revising tax, obviously you've done a lot of work on aggregate demand and aggregate supply, hopefully. The point I really wanted to take away from this webinar is that taxation has quite significant effects both on demand, aggregate demand, and also aggregate supply. So this slide thinks about some of the ways in which taxation can impact on demand. Cuts in income tax, for example, affect disposable incomes and should in theory boost consumption. Key evaluation point there is that if you target a tax cut, for example, towards poorer families, you might actually get a bigger consumption effect, because typically they may have a higher propensity to spend. Corporation taxes, in theory, should affect the level of planned investment by businesses, although you can argue the extent to which that's the case. And again, you can make a case for saying that maybe targeted tax cuts for smaller businesses might help. Taxation of imports affects trade. So, for example, an import tariff, that would affect the value of M in C plus I plus G plus X minus M. The rate of national insurance affects the demand for labour. Interestingly, the government's cut national insurance for businesses that employ long-term unemployed workers, which I think is a smart move. VAT affects prices and real incomes, and therefore consumer spending. And tax can also affect demand side, affect the level of innovation and research and development spending in terms of investment there. So taxation can have quite significant effects on aggregate demand. But importantly, from the point of view of this revision webinar, tax can also have a hefty, significant, important effect on aggregate supply. And many students don't quite really give this enough emphasis in their exam answers, I think. So tax changes in tax rates and tax allowances can affect both short-run aggregate supply, but more importantly, I think the tax system has an effect on long-run aggregate supply. You can almost regard fiscal policy as having quite strong supply-side policy properties. The tax system, for example, can affect the incentive to work. Some people may decide that the tax and benefit system isn't providing them with a sufficient incentive to work, and they may choose to remain economically inactive. Tax treatment of particularly high-skilled workers may affect inward migration levels. And we know that a lot of investment across countries is dependent a little bit on the rates of corporation tax and the extent to which companies can take the profits with them. Tax treatment of small businesses, tax treatment of business startups is important. For example, capital gains tax and the incentive to start a business and eventually sell it on. The tax treatment of tax treatment of things like tuition fees, graduate tax possibly affects the incentives to study. So there's all kinds of ways in which, and import tariffs obviously affect the cost of imports, all kinds of ways in which tariffs can affect aggregate supply. Now let's move on to the budget balance. So of course the budget balance is the annual difference between government spending and government tax. This table here shows that the UK government has been borrowing heavily as a share of GDP in every year since 2008, 2009. The budget deficit went up from 2.7% of GDP in 2007 to more than 10% 2 years later. Of course, that was the direct result of the recession, which caused a big fall in tax revenues. Since then, gradually, painfully slowly for some people, the budget deficit has been coming down, and the budget deficit is now below 5% of GDP. The level of debt, of course, in the economy, this is net debt shown here, the level of net debt owed by the government sector has gone up, but it's more than doubled from just under 40% of GDP in 2007 to over 80% net debt in 2015-16. So clearly the British government has a much higher level of debt than it had 10 years ago. Everybody happy with the difference between the deficit and debt? Deficit is how much you borrow in a given year, and the debt is your total accumulated debt that's yet to be repaid. Here are some countries with even higher debt than Britain. Japan and Greece are outliers. Japan has over 240% of government debt, Greece 170%. America just squeezes in at the bottom there with a national debt just over the size of their economy. Now, many countries have very high levels of national debt. Debt has gone up because fiscal deficits have been pretty high in the wake of the global financial crisis. The big issue, I think, really is two things. One is how much debt is the government in? And the answer for many countries is lots. The second big issue is how much does that debt cost to service? How much does it cost to borrow the money that governments need to in a given year? Well, the cost of debt is determined by the yield on debt. The yield is effectively the interest rate on a government bond in percentage terms. A government bond, let's say worth £1,000, will pay a fixed interest, let's say £50. The interest is fixed. So if you've got £50 of interest and the bond costs £1,000, then effectively the interest rate on that bond is 50 over 1,000, in other words 5%. So the yield is the percentage cost of borrowing the debt for a government. And notice here that Greece has a very high yield for 10-year debt, much higher than, for example, countries like the United States or even Spain. So Greece has a high level of debt and a high yield. So it's costing it an absolute shed load of money to pay for the debt interest. Whereas countries like Finland, Holland, Germany, Japan, their yields are much lower. So the cost of servicing the debt for those countries is significantly lower. The UK government, let's come back to that in a second. The UK government can borrow very cheaply, actually. The UK government can borrow at about 1.8, 1.9% at the moment. So that's quite important from the point of view of debt servicing. Big debate at the moment about whether the UK government should be trying to continue to cut their deficit. We know there's been a lot of fiscal austerity in recent times, and I'll do a separate topic video on the economics of fiscal austerity for you. The arguments for and against cutting the deficit. Keynesian economists are fundamentally against deficit reduction. They don't want governments to be cutting borrowing, especially if they think the growth rate in the economy is pretty weak. Keynesians would favour, for example, an increase in government borrowing on investment, transport infrastructure or telecoms, or sanitation investment, new schools and hospitals. Whereas fiscal conservatives believe that, yes, actually the government's right. It is right for the government to try to balance the budget. The debt needs to come down at some point, and to do that the deficit has to come down. And the famous phrase they use is that you should mend the roof when the sun is shining, not when it's pouring down with rain. That the government in fact should be cutting the deficit a bit quicker so that public finances are in better shape the next time we go into a recession. I'll do a separate topic video for you on the economics of fiscal austerity. Just safe to say, a couple of slides to finish with, that Osborne has now brought in this new fiscal rule. I'm not quite sure where it came from, in other words, which planet it came from. But anyway, the new rule is that Osborne is targeting a budget surplus by 2019-2020, when all of us will have finished our levels by that point, and for all subsequent years when in normal times. So Osborne believes that when the economy is in, brackets, inverted commas, normal times, the government should be running a budget surplus. And the government says that the economy will be viewed as being in normal times if real growth is above 1%. Well, anybody can tell you that the growth of the economy in the UK normally is around 2–2.5%. So if the government's suggesting that normal growth is 1%, either they don't understand what the difference between 1 and 2% is, or they know something we don't know about what growth is likely to be in the years ahead. Strikes me this is rather a silly rule. I can see the arguments for cutting the deficit. I can see the arguments for trying to reduce the size of the debt as a share of GDP. But this rule is just plain silly. The deficit has come down. It's come down painfully. In 2010, the government borrowed £150 billion, and it's only just got it down below 100. It's now about 75 billion in 2015. The government is hoping that their fiscal austerity programme will bring the deficit down until eventually the government accounts are balanced, and then the debt will start to fall as a share of GDP. Now, for this deficit to fall, the government will have to continue to cut spending, in some areas quite deeply in real terms, and or it will need to grow tax revenues, because the best way to get the deficit down is to have a growing economy where incomes are rising above inflation, where companies are making more profit and paying their taxes, and where there is a wider base of taxation, more people in work to generate the extra revenue from spending and income. So the coalition's plans for the deficit depend fundamentally on keeping the economy growing. And to an extent, that's not really anything that they have much control over. They are moving towards more investment as a way to kickstart growth and long-run supply. But basically, the growth rate of the economy doesn't depend on fiscal policy. It probably depends more on monetary policy, the price of oil, the strength of the world economy, and other external factors. So we've had a little whirlwind tour around some aspects of fiscal policy. Hopefully this has been useful. I will do a separate topic video for you on the economics of fiscal austerity. But good luck in your macro papers. Thank you.